Hello, this is Edmund Shing of BCS Asset Management, discussing today global market trends. Are we at a turning point in global markets? We're going to look here at four things. Firstly, we're going to look at stock market trends. Then we're going to look at volatility trends. Thirdly, what's happening in emerging market trends. And finally, the bond market. What are we seeing there? If we look here, first of all, to the US market, we can see that the average US stock is still in an uptrend, as you can see from the grey line pointing up. It has not been broken and has simply seen a small pullback. So the 14-month bull market trend in the average US stock is still very much in place. Here on page 4, we see a very similar trend in Europe. The Stoxx Europe Equal Weight Index, again the average European stock, is still very much in the same uptrend that it's been in since the middle of 2013. So as far as stock market trends go, we don't see any real break in developed market uptrends yet. Turning to volatility, this shows the US VIX Midterm Volatility Index, and you can see that while there has been a very small rise in this index in the last few days, it is still extremely low in comparison to the last spikes in volatility seen in mid-2013 and also in earlier 2013. Volatility levels, as far as the stock market goes, are still extremely low. Here on page 6 we have another way to look at volatility via macro volatility. This is the Citi Macro Risk Index, and as you can see on the right hand side, yes, there has been a spike in this index, the risk index, to about 0.4, but this still is nowhere near the peaks seen in the middle of 2013 or early in 2012 or even in late 2011. So again, in the grand scheme of things, historically speaking, we're not at a crisis point yet, at least judging from this index. Turning thirdly to emerging markets, well, this is the EEM, which is the main emerging market stock ETF in the US, and you can see that thus far the EEM has not broken the lowest point seen in the middle of last year. So again, it's not dramatic. Yes, it has fallen, but not dramatically as of yet. If we turn to emerging market currencies on page 8 and we look at the right hand side, we can see that the Russian ruble, which is the line in green, has seen a sharp spike in volatility. However, when you look at other emerging market currencies such as the Indian rupee, which is in dotted grey, or the Mexican peso, which is the line in blue, we see a different story. It's not quite as obvious there that we've seen a sharp rise in volatility. In fact, the medium-term trend in volatility in these two currencies has been down. So I think the emerging market turmoil is something that clearly affects certain markets more aggressively, but is not necessarily being felt equally by all emerging markets. Now, if you look at high yield bonds, you can see very much the same story. There has been a small rise in the US high yield corporate bond spread over equivalent treasuries, but it's been very small. The general trend remains the same. It is of declining high yield spreads, which again highlights the risk on trade, which is still in general working. So to sum up, what do we have here? We have stock market trends, uptrends, still intact in the US and Europe. We have volatility, which in the midterm remains modest, and with macro risk indices that are nowhere near the heights that they reached last year or even the year before. Thirdly, we have mixed reactions from emerging markets. Certainly Turkey and Russia have suffered, but other major emerging markets like Mexico and India have remained relatively calm. And from the bond market, there's no obvious big flight to safety move that we can see. So the conclusion is that we should remain long risk assets like stocks for now. We see a bump in the investment road. I think the main question remains the tapering timescale of the Fed, the Federal Reserve, and we can see that recently they've cut this monthly bond repurchasing by another $10 billion, now down to $65 billion per month. But how aggressively they continue to cut that, I think, is a major question for markets today. This is Edmund Shing from BCS Asset Management, wishing you a happy Chinese New Year of the Horse 2014, and I hope to speak to you again soon.